Hello and welcome to this very special Christmas edition on Moneycontrol. The market doesn't seem to be in any mood to give us Christmas gifts, but we are here with some influential voices that should help you approach the next year with some degree of confidence. I'm Mahalakshmi and I have with me Ashish Gumashta, Executive Chairman of Julius Baer, and he should tell us something about how the really rich investors are approaching next year. Ashish, thank you so much for joining me today.
Thank you.
Tell us, today the market's probably going to be in the red. Going into next year, what is the sense you're getting in terms of what investors are really thinking? Because you are somebody who advises most rich and savvy people out there in terms of how they should manage the money.
So, Mahalakshmi, we are going through a very interesting period at this point of time. Indian businesses have emerged very resilient. So, learning from our last crisis, I feel most businesses have been deleveraged, balance sheets are stronger, much more robust, and most of our promoters realized and they started raising capital. So, be it businesses, be it families, capital has been raised. Indians also have a very large investment always in real estate. So, real estate in the last 12 to 18 months has done well. So, we are going through a very interesting phase where the world is going through a set of crisis, but somehow Indian businesses have done a very good and resilient job. Now the debate in everyone's mind is twofold. Number one, we are doing well, the world is going through a challenge.
Yeah.
Where is the mismatch, and have we got it right, or do we be cautious?
Right.
And the second thing is, at what phase do you press the accelerator? Because balance sheets are deleveraged, demand is there. We've ridden through some of the toughest economic challenges. So it's a very, very interesting phase, and almost every family that I meet, and I've had the last couple of weeks, I've met with some of our big business groups. I find that at one end, their business seems to be holding well,
Right.
fairly deleveraged,
Right.
and at the other end, they see a huge opportunity. So it's at a cusp, at this point of time.
So one thing that is clearly coming across is, on one hand, in the banking system, if you see, there is a lot of credit growth that is happening. But at the same time, if you look at the Capex cycle, there you don't see companies really pushing the envelope and going out and investing. So from a promoter's perspective, do you see them investing more in businesses this year? Or is it going to be through, they're going to utilize those dividends and monies that they have into investing in markets?
Right. So, banks are in a very interesting situation. You have huge credit growth, and deposit growth isn't so much. Approximately
Correct.
17 to 18%, deposit growth is 10%.
Right.
Fortunately, our banks are in a very strong position. Coming out of the last crisis, balance sheets are strong here. Promoters have started embarking on Capex, and in the last 12 months, the kind of confidence I've seen is unheard of. So I feel that in the next 12 to 18 months, you will see some major Capex expansion by Indian businesses. As far as investing in the financial market goes, the new asset class, which is private markets, is the new thing. So if you remember, traditionally Indians always invested in businesses. You invested in some relative starting a business or some agencies, etc. Now that market is switched to a more organized private markets, and that is witnessing a correction. So, so I feel at one end, promoters are looking at investing in their own businesses. At the same time, they are also looking at investing in other alternative businesses. So the alternative asset class in the coming years should grow well. That's the kind of feelers I get from
So by alternate, you mean venture capital, private equity kind of funding?
That's right. So the early stage, the mid stage, and the late stage. The challenge here has been that these valuations had run ahead of the listed markets. Now that correction has started, and I think in the next 12 to 18 months, that space will also become very, very interesting. So while public markets always remains as an exciting area, I think that's another area we find clients very interested in looking at.
So when you juxtaposed public markets versus private markets,
Yes.
do you think a bigger share of money flows this year will go into private markets? Because there you see a lot more pain, because there is this funding winter outside of India. Unless the rate cycle really peaks,
Right.
I don't think that scenario is going to change, in which case will they be pushing harder in private markets instead of public markets?
What is happening is globally, you're aware interest rates are moving up. And a lot of fixed income money had come into equity because interest rates have fallen. But now fixed income is very attractive. Today, a 1-year bank CD is at 7.5, 7.75. So I actually see money flowing back into fixed income. So the first area where you'll see again money coming back both locally and internationally is in fixed income. So fixed income becomes a attractive space. As far as equity goes, I think listed markets still continue to attract capital because of the liquidity factor. People can get out of it. But private markets in the next 12 to 18 months will again be a very interesting space. But at this point of time, most investors are in a wait and watch mode. They feel that they would be wanting to be in this space, but they would want valuations to be more reasonable.
In fact, that is the question I was really going to come to, because if you look at flows last year, of course, every time the FIs were selling, DIIs were buying, and that was like a really strong counterforce that has emerged. But if you just decompose that DII figure and look at, how much came through SIPs, insurance, discretionary, the discretionary part of investment has really come down to a trickle.
Right.
So do you see that changing, or you have to wait and watch into next 1 or 2 quarters to see any decisive change there?
So the challenge of our business is that most of the time we always get money at the fag end of the rally. So there's real risk and there's perceived risk.
Right.
When real risk is there, people don't really, when real risk is low, people don't invest. And when perceived risk is low, people are all, like coming in and investing. So, so what's happened is we had a lot of capital coming in the last 12 to 18 months, and markets haven't really gone anywhere. Now that has led to concern in the minds of the investors that are we going to make money? Are they not going to make money? So it's a wait and watch situation, because if this discretionary or if the high net worth start redeeming, then it could be challenging. But at this point of time, I think people do still have a long-term view on India. We are going through a very challenging period, right? I think earnings-wise, the world is seeing a challenge. So it's a wait and watch situation. But the financialization of the economy is definitely happening. I mean, in the last 2 weeks, I have traveled to Kolhapur, I've traveled to Nasik, I've traveled to a lot of tier 2 towns. And it's amazing the scale of financialization which is happening.
Sure,
it's unheard of, the scale of the economy, the kind of businesses which are coming up. Met forging companies which are doing well. I met tech companies in Nasik. I mean, I could not imagine the kind of tech businesses which have come up in Nasik and the kind of talent which has come up there. So my gut is that flows will still continue to come in, but it's a wait and watch situation.
So when do you see that happening? Because last quarter, discretionaries have nearly become negligible.
That's right, and that has to do a bit with the performance, right? Because a lot of money came in the fag end of the rally, they underperformed the index, and a lot of that will depend on earnings growth. So right now, seeing the global scenario, what's happening to the world, earnings will be in the 8 to 12% region. So I would be cautious. I feel the discretionary money is looking at some correction, and at that point of time, it would come in.
What kind of correction?
Maybe a 5 to 10% correction. Yeah, okay. But otherwise, I think our fundamentals are on place. The bigger challenge is what's happening in the world. What happens to Europe? What happens to the US? Where do interest rates stop? And our exports will get impacted, right? We have a very delicate fiscal situation at this point of time. Our tax collections have been good. So I think as a country, we've done an amazing job. We should not be complacent.
Sure.
And hopefully, with that, we'll continue to attract capital. I mean, right now, globally, in the segment we deal in, which is high net worth, ultra high net worth, we see a lot of interest in India. I mean, all the hotels are full, all global board meetings. In the last 2 months, I've attended 8 dinners of global boards who've come to India, and they are all hosting their global meetings here.
So 2 things. You're saying there are people outside of India who are waiting in the wings to join the party if the earnings story becomes better or remains resilient. Right. Second is people in Kolhapur and all the other new rich people are also waiting in the wings to come in. Now, tell me, there was another trend that happened last year, in fact last 2 years, that a lot of Indians were looking to invest abroad because you were seeing all these Amazons, Microsoft, all of these companies galloping in the post-pandemic era. But that kind of mellowed down because of the carnage that we saw in NASDAQ last year. Right. Now you're already at a low out there, and more, more perhaps a little more downside as the rate cycle continues to peak. Do you see some part of our money going out once again?
That's right. So that is genuine diversification. When you invest globally, you genuinely diversify. We are now, as a country, we've reached a stage where we are now global Indians. Almost every family has got one member now living overseas. I mean, if you go to any Indian family, there will be somebody living overseas. So we will diversify, we will dominate the world in the coming decades. And this is a part of the investment process. So businesses are investing overseas, individuals will look at investing overseas, we will look at diversifying. One of the reasons also the flows reduced was there was a cap which was put in the mutual funds, so that that cap got reached. But I think it's a good process, which is
but there is also direct equities that people can do, right? Or
that's right. Yeah, they can do it, but again, the volatility, the level of information is not easily available. I think the way we are approaching it from India is in a very structured manner. So Indian wealth management firm, financial providers are coming out with products. And that becomes a very good. So players like Julius Baer, we brought in our global funds into India, global diversity. So those products then become much easier to go by. Because again, your ability to analyze those stocks and variables is very different than what it is. So to answer you in a nutshell, yes, international diversification will be a part of it.
So that will take a big chunk, you think?
Not
because
really,
relatively, if you look at India versus US, I mean, of course, we should feel happy about the fact that we have done exceptionally well. But at the same time, those markets look much cheaper.
That's true.
So you talked about perceived risk versus real risk. The real risk out there perhaps is lesser compared to India. So would you say
the way I would put it is that the financial assets itself is very low. So I think that pie will become larger. So instead of buying a real estate, you can buy into a REIT of Singapore or the US. So my guess is that the pie will become larger. So India will gain and globally people will gain, because today a lot of money goes into the illiquid asset classes, and as financialization of economy happens, more and more product range will be available. The product range today you have available globally is much wider than what is available in India. As far as India goes, I'm very confident that we'll continue to attract capital. I just hope we don't get complacent with our success. We've really stood out. I think this government has done a very commendable job. We've had very robust tax collections. We should not get complacent as a nation. So the pie will get larger and larger. And India will benefit as well as global investors will benefit.
Sure. So one more point before I get into the complacency part is, people say that one of the things that really helped equities in the last 1 or 2 years is low interest rates. So a lot of money moved because you didn't see any point in putting money at 4% and 6%. But now the complexion of debt has changed phenomenally, and perhaps we have 1 or 2 more rate hikes to go. Are your investors thinking of switching big time to debt?
No, so people are definitely looking at fixed income because it has become a very attractive asset class. What was happening is because interest rates were low, different kind of exotic debt products were coming in. And I feel the real risk there was higher and perceived risk was lower. But now with your AAA in the 7.5 range, suddenly your fixed income becomes a very attractive range. So there my advice to investors would be still to be cautious. Stay with good quality credit, but definitely it's an asset class both in India and overseas investors are looking at it. In US again, fixed income has become attractive. You had a 0% regime across the world for a very long period of time. So there will be a shift of money which will happen there. But again, in India, the benefit we get is our financialization is small. So we have a wider market. I think banks will attract deposits. We will gain. So as a nation, I think we will gain. Our savings rate was going down. I think that should stabilize with higher fixed income. People had gone back to consumption. I feel again savings will come back.
Sure. So 2-3 things you have said. One is that from an equity market perspective, one is that bonds are looking more attractive. So a lot of money could probably move into bonds. You're also saying that people are waiting to see if earnings performance will hold up and valuations will sort of become more muted so that you can flow back some money into markets. There is additional money that is waiting to come both from domestic and foreign investors, which could prop up markets if valuations and earnings story both turn to be a little better. Okay. What are you advising clients in terms of where are there any pockets of opportunity that you see in equities which look really attractive and perhaps could be good hunting grounds as you go into next year?
Yeah. So now, like I said, in fixed income, your opportunities in the AAA space, don't buy long term, but look at defined duration. You have these defined duration products. So they are fairly attractive. where will interest rates go, where will they end
Defined duration means the fixed maturity plans.
Yeah, so you have the 2-year, 3-year maturities, where you get in and you're in the 12 months to 36-month range. I think that is very attractive because we have a flat yield curve. Your 10-year return and your 2-year return is virtually the same. In fact, we have an inverted yield curve.
Right,
So currently, I think this asset class looks good. Our job is not to play God and guess where interest rates will end, but based on the facts that you're seeing, advise investors on what is going to happen. If COVID situations worsens, interest rates may come down a bit. So, this space looks good in the fixed income space.
So, you're saying this year 8% from debt looks better compared to the risks that are stacked against the equity markets?
So, equities, I would say the way to look at equities is earnings growth looks like it will be in the 8 to 12% region. I mean, it's my personal call. My head of research in equities is a better person to guess that, but that's my personal call. And if I put myself in the shoes of an investor, Europe seems to have seen the worst. They're coming out of it. US, will there be a recession? Will there not be a recession? But if US, Europe, and China is facing a crisis, how can I, as a country, I mean, you are bound to get impacted, right? If all the buildings around you are in trouble, your house will also get impacted in some way. So currently, it looks like muted investment growth. So I would say to invest, to be a bit cautious in the next 3 to 6 months, see how events unfold, and then go about investing. I think our banks are very strong, so banking looks pretty good. In terms of manufacturing, we've got our act together. Again, that's an interesting space to be in. The government continues to spend. We are very delicately poised with our current account deficit fiscal, so we'll have to watch how this budget pans out. We are heading for an election in 18 months period of time. So I would invest, but gradually in the next 3 to 6 months. That's what my advice to investors would be, and have more realistic return expectations. But I think we should still do better. Equity should still do better than any other asset class at this given point of time, but more realistic return expectations.
Sure. And you talked about being complacent earlier. First of all, what part of, is there anything that the market is building in terms of expectations from the budget?
I think as a country, we should be very proud of what has happened. We've had a stable currency. We've managed our fiscal situation well. Our current account deficit seems to be under control. Perception of India is excellent. I have never seen so much interest from global investors than India than ever before. Now, traditionally, your success becomes your challenge. So we've got to keep working towards it as an economy. We should not feel that we have reached there. So I think that's what we should work towards. At the same time, inequalities of income are in the rise globally. So you've got to make sure that the lower strata of your society is equally taken care of. So yesterday, again, there was an announcement with the government where they've taken care of it. So I think we've done a good job so far. The leeway for the government is very little in terms of what they can do in terms of tax, etc. But so far, touch wood, I think everything seems to be. I mean, it's a picture postcard. I mean, and we should be proud that it's panning out this way. Right.
And anything that would disappoint you from the budget, because the market's been kind of worried about this capital gains tax, any tweaks out there. Is that a big worry?
No, I feel this government has indicated in terms of stable policies, right? So from what I read in the papers is what they are talking about is a uniform tax regime, and that's there's nothing wrong with that. So I don't think there would be too many surprises in this budget, because most of our policies are fairly well laid out information. So I would not worry so much about the budget as much as some global event triggering some currency crisis. Like today, for most central banks, maintaining their currency is the biggest challenge. So I think what I would watch out for is crude. What I would watch out is for the China-US war on how it's really panning out, and which way are interest rates heading. I think that will have greater ramifications for us than the budget, because in terms of budget now, we have a fairly stable policy on how we are going about it.
Sure. If you were to say one risk or something that takes away your sleep at night, what would that be?
I think the China-US equation, because they are both giants. We are dependent on China because, again, it's a huge import. We have a huge import thing with them. It's our neighbor.
Yeah.
In border, you see from time to time situation.
Yeah.
And US again is a very big trading partner for India. I think that is something for us to watch about. Right now, this situation seems to be benefiting us. But that is something I would watch out for, because if that challenge grows, then you could have some currency war or some such thing. But right now, things seem to be under control. From an Indian economy perspective, only crude. So our forecast is we are neutral on crude. We don't see it flaring up, which should be good. If we have what will change, what will make me very bullish on India is if we have a 15 to 20% fall in crude. Then it suddenly the whole game changes. Raw material prices fall. We are a price-led economy. So again, demand comes back, the economy comes back.
But I mean, it has been, crude, as much as we worried about crude last year, it's been a surprise. It's been a fairly, benign range.
Yeah, again, full credit to our government on the way we've handled the situation, the way we've handled the oil part of it, because that is the single biggest factor which can change the economics for us.
Correct. So now take a guess for this year, GDP growth rate.
Look, I'm not the best guy in GDP, but I'm optimistic on the country.
7%?
No, I mean, that's for our economists to say. But I think we should do well. Based, again, anecdotally, it's based, I'm talking as an investor. What I see when I meet companies, when I meet businesses in Kolhapur, I just met 2 of the largest forging guys. They seem to be doing well. Everyone is thinking of expansion. Coimbatore, I was there. I was with some of the with the pump manufacturers again. So my gut is in our segment of clients that I meet, the situation is good and things are on track. Hopefully, backed by some manufacturing focus, we should be able to do well.
So I think the biggest takeaway from your conversation, Ashish, of course, everything you said about equities, risk reward in domestic markets, outside, etc., is that you see private capex picking up in the next 12 months. You're saying all the entrepreneurs you meet are already sort of waiting
people
out
have
there to
started
start
believing
investing.
in 10-year India story. See, that 10-year or a 15-year story was what was in doubt. Now that faith is there. So people say, look, whatever happens in the next 12 months, we are thinking for the next 10 years. I think that is the big change I've seen in the last, if there's one key takeaway, which I have in the last 1 or 2 months of meeting families, is that now people believe in a 10-year story. Previously, one would talk about it, but one was doubting about it. So they believe in the 10-year story. Indian families are thinking global. I think the confidence level is, and life is all about confidence, right? I mean, if you're confident, then you can turn around the most pessimistic situations also.
Sure. So one question on that, because we are talking about industrials, the market is already pricing in a very strong recovery in that entire pocket. So from a stock market perspective, the sense that you're getting, is it validating, or is it that, markets are pricing a little more than the pace at which all this money can come into making?
So the number of industrial stocks available are few. So you will see a lot more companies listing, more diversification, more businesses coming in, and then valuations regularizing, or you have time correction. So that's what I told you at the start, that equities as a story, we've had time correction for 12 to 18 months. You may have for another 6 months. And then naturally your earnings normalize, because then you have 2 years of earnings. We are looking at FY24, we are looking at FY25. So I think you'll see a lot more industrials listing. You'll see a lot more businesses coming to the market, capital being raised, and more options available to the investors, or you may have some time correction. But some of these businesses will surprise us on the demand side, because again, businesses have been consolidating, demand has been built up, and then suddenly the hockey stick curve kicks in. So I would hold these businesses.
Sure. Thank you so much, Ashish. It was a great pleasure talking to you. On that note, optimistic, cautious?
No, optimistic always.
Optimistic as always.
That's my nature.
Okay.
Cautiously optimistic.
On that cautiously optimistic note, have a wonderful trading session and a start to a very good week. Thank you so much.
Thank you.